Hello my fellow investors, welcome back to another stock analysis video. Sorry for not uploading today guys on the 26th at 4 p.m. After Christmas. Everything was crazy, it was just didn't have time on the 26th to pretty much get a video in, but I'll get this one today. You'll probably see this around like 8 p.m. Eastern Standard Time, but nonetheless guys, let's actually analyze the company Sportsman Warehouse. And this one was brought up by Tony around 13 days ago and a certain amount of times later on after that first initial message, and also was brought up by Michael Bernay. I don't know if that's how you say your last name, but sorry if it's not, but both of you pretty much said do this company, and I also realized that they had earnings as well as of December 7th. So now is a pretty good time to take a look at this company as well as their earnings to find out if we want to invest at the current price. So with that said, let's get started with this analysis. So let's actually come over here to Seeking Alpha and see the last quarter's earnings. We got here EPS normalized actual came in at 34 cents, which was a beat by 5 cents. EPS gap actual 33 cents, beat by 5 cents. Revenue came in at $359.72 million, which is beat by $3.43 million. Now my issue when it comes to these earnings guys is that remember, this is based off of what analysts believes. This is not telling you if year over year they went up or not. So for that, let's come over here to the actual earnings release. Now, like always, this will be in the link in the description below if you guys would like to read the entirety of it. Now, let's actually start off with the CEO's comments. Quote, "We executed our strategic initiative and reported strong sales earnings result in the third quarter despite the challenging macroeconomic environment," said John Barker, Sportsman Warehouse and Chief Executive Officer. "The investments made over the last few years to enhance our omnichannel, that's a word, capabilities have strengthened the overall foundation of the business. Moving forward, we will continue to closely manage the business with discipline and rigor and maintain focus on leveraging our investments while accelerating the growth of our store's footprint to reach more customers nationwide." Now, all of that sounds rosy. However, they do not have the things that I actually wanted to see, at least when it came to the year-over-year increase, when it came to their, for example, starting off net sales. It was $359.7 million, which is a decrease by 10.3% guys compared to $401 million third quarter of fiscal year 2021. You also have same store sales, which by the way guys, remember, as a retail company, you really want to take a look at same store sales because this one essentially tells you whether or not the sales is actually increasing or are they just opening up more and more stores, making it seem like the sales is going up when in reality the sales actually going down or remaining stagnant. But because they're opening more and more stores, it's looking like they're selling more when in reality they're not. So the fact that same store sales decreased by 15% in the same quarter as of last year to this year, that's also really bad. However, as you can clearly see here, compared to the same period of 2019, same store sales actually increased 19.5. So you actually have a little bit of like a give and take here and there. Actually, I didn't even read this part over here. You also have it in the net sales up here as well. Compared to the third quarter of fiscal year 2019, net sales increased 48.3%. That's a massive increase as opposed to this 10.3% decrease. But nonetheless, guys, the fact that from 2021 to 2022, same store sales and net sales did go down, it's very concerning. Notice how they're not mentioning 2020 because of the whole pandemic situation. So they're bringing it back to 2019, which I think is perfectly acceptable. However, the fact that as of 2021, we weren't really in the pandemic anymore, and even 2022, we're really starting to come out of it now. I mean, we're essentially out of it now. The fact that it decreased, that's actually concerning, right? Because if in 2021, we were still somewhat pseudo in the pandemic, 2022 we weren't, and it still decreased, that's very concerning. Gross profit, $120.8 million compared to $129.6 million. The prior year was also another decrease. So as you can clearly see, guys, it was decreasing a significant amount. And looking at the condensed consolidated statements, you can see that, well, from one year to the other in the net sales alone, it was a decrease of $41.3 million. That is not good at all. And even the earnings per share, basic and diluted, did go down from 50 cents to 34 and from 49 to 33. So all in all, guys, this is looking like it's started to decline a significant amount. So let's actually come over here to the calculator. We got the ticker symbol for SPWH. Market cap, they're a really tiny market cap, $344.18 million, and a PE of 4.5 $1.5 with a current share price of $9.13. This PE, guys, is really tiny, and this market cap is very small. So you are now investing into a pretty small company. That doesn't mean that it's a bad company to invest in. Obviously, you have to analyze it a different way. However, understand that you're probably not going to see the cash flows that you would normally see when it comes to like a major corporation. Now, looking at the graph on the 1 year, they're down 20.54%. On the year to date, they're down 23.3%. 52-week ranges is actually interesting, going from $7.75 to $12.28. We're not at the 52-week lows, but we are pretty much at the lower end of this scale. Now, they do not pay out a dividend, which means all of their cash flows going straight into themselves. And in fact, take a look at this. This is actually kind of concerning. 5-year average free cash flow is $39.06 million, and last year's free cash flow is a negative $75 million. That's very concerning. So let's delve into now their fundamentals to see what in the world happened with these cash flows, and of course, other numbers as well. So starting off, guys, we got the net income 5 years ago of $17.7 million to 1 year ago of $108.5 million. Now, before we go on, I would just like to note that 3 years ago was actually COVID for them. So now we're getting to the point where 2020 is now 3 years ago instead of 2 years ago. So just keep that in mind. The fact that we do see a decrease from 4 to 3 years ago, I think that's perfectly explainable. What I don't like is this massive jump from 3 to 2 years ago. And also, I forgot to mention that on the 5 year, this is an increase of 513%. My main concern is actually not this decrease from 4 to 3, is this massive jump from 3 to 2, going from $20.2 million all the way up to $91.4 million, and then again $108.5 million. Now, my one concern would be, they could not replicate this number again back in 2 years ago. However, they clearly did 1 year ago. But again, will they continue to do this into the future? We just saw that their net sales did go down, so I don't necessarily know how this will affect it, right? In fact, their trailing 12 months isn't over yet. They end in January. So we're going to have to wait and see one more month what in the world happens with this net income. Now, I'm going to have to give this guys like a 35% because these anomalies right here, these massive jumps, is not something that I like. Coming into the free cash flow 5 years ago, $10.4 million. Let me rephrase that. Negative $10.4 million. All the way down to negative $75.1 million. That is a decrease of 622%. Guys, that's horrible. And then that is an average of $39.06 million. Take a look at this. They were increasing from 5 to 3 years ago. Okay, that's all good and dandy, even during COVID. And then they did a massive spike 2 years ago, going from $47.5 million to $219 million. And then they just completely crashed afterwards. And let's actually take a look at this, because the cash from operations in this year actually went negative to negative $21.6 million. So this wasn't a case of, it was just the capital expenditures was higher. No, the cash from operations went negative. So that's very concerning as it stands. And I'm going to have to ding that a lot. In fact, I'm going to have to give this like a 10% because cash from operations going negatives, that is not good. You can make an excuse for capital expenditures going higher than cash from operations, but not the other way around. Looking now at the revenue, this one actually isn't looking too bad. 5 years ago of $809.7 million to 1 year ago of $1.51 billion, increase of 86%. And they did have a pretty moderate jump from 3 to 2 years ago, but honestly, I'm gonna have to give this like the best score so far at like a 50%. Total assets minus total liabilities. This is looking like a pretty consistent increase on the 5 year. As of today, they're in the positive to $283.3 million. By the looks of it, they will not be able to match or even surpass 1 year ago. So that's a little bit of concern, but they're still in the positive. Average total assets is around $686.5 million. Average liabilities is $488.26 million. Doing this difference, we get almost $200 million. I'm going to have to give this like a 60%. Into the cash flow minus the total liabilities. Guys, it's not surprising that the lowest point was actually 1 year ago because, well, that's when we saw the negative cash from operations. So the fact that 1 year ago it was negative $717.2 million, that's very concerning. Now, with that said, we can see that 4 years ago to 2 years ago, they were actually consistently increasing, which is something that I like. Again, the main issue is that cash from operations going negative. Average cash flow minus the average total liabilities, we get negative $450 million. I'm going to have to give this, I don't know what I'm going to give this. I think I'm going to give this like a 35%. Looking now at the shares outstanding, we got 5 years ago 42.6 million million shares to today of 37.7 million shares. That is a decrease of 11.5% on the 5-year, which is massive. And take a look at this. This is insane. I saw it. I was just like, what? That's crazy. Previous year to the current year, negative 14.12%. That is a massive decrease. And in fact, you can see that from 5 to essentially 1 year ago, they were increasing shares. And by the way, their increase wasn't even that much. 42.6 million to 43.9 million, that's not that much. It's still an increase, but it's not that much. The fact that this company doesn't pay out a dividend and they're not issuing any more shares than this from the 5 to 1 year ago is actually very surprising. However, what's even more surprising is that today they have went down a significant amount, guys. So that's really good. It's really good. However, when it comes to a grade, they were increasing it. Their tendency is to increase it. This is an outlier right here. I'm not going to dig them too badly, but I'm going to say like the 60%, I would say, mainly because, again, their consistency is to increase it, not to do these massive buybacks when it comes to the shares outstanding. And lastly, when it comes to the cash equivalents, they currently hold $2.6 million with an average of almost $22 million. Looking at the weighted grades, guys, net income 35%, free cash flow 10%, revenue 50%, assets minus liabilities 60%, cash flow minus liabilities 35%, and shares outstanding of 60% for an overall grade of 38%. My biggest gripe is this free cash flow. The fact that it went negative is such a big problem. And that's the thing too. If you were to see like, okay, 5 years ago they were negative, but each year they were consistently increasing. Even if there was an outlier year, fine, whatever. But at least they were still consistently increasing. The fact that 1 year ago you saw negative free cash flow, even lower than what it was 5 years ago, and the cause of it wasn't because the CapEx came in higher than the cash from operations. It was the fact that cash from operations was in the negatives. That's very concerning. That's my main gripe with this, and that's why I'm giving it a 38%. Now, with all of that said, what do we actually pay for this company? Because even though it's really losing free cash flow and every investment is the present value of all future cash flow, that doesn't mean that this company is worthless. We could still find a decent price to pay for this company. Now the problem is, well, I don't necessarily know what to put for these. So coming over here to Seeking Alpha, we can see that the forward revenue is estimated at 2.27%. And actually, take a look at this. The year over year is negative 6%. So I'm not going to go into negatives. I'm just going to go really, really low when it comes to the forward growth. So let's say the revenue growth at around 0.5% for the low assumption. For the median, let's go to 1%. And for the high one, let's go with 1.5%. For the projected share buyback, I don't think that they'll do another 14% increase or decrease. I think that they'll actually begin to issue a little bit of shares here and there. So in the next 4 years, let's say, I don't know, let's just say negative, let's go with -2, -1, and let's say at around 0, right? Let's just say 0. So with that, guys, we get the target share prices, not adjusting for debt, with a required rate of return of 10% of $72.83 to $77. Okay, adjusting for debt, this comes down by around $10 or so, $62 all the way up to $66, adding a margin of safety of 5, 10, 15%, $52.72 to $62.67. So as you can clearly see, this is looking like an all-out buy. With a current share price of $9.13 and a PE of 4.5, this is looking like an all-out buy. However, in my personal opinion, the way that I look at this is like, yeah, it may be a great buy, but these grades, these fundamentals are just not there for me. I'm sorry, it's just not there for me. Obviously, you might see possible growth when it comes to this company. I'm not saying that you can't have growth when it comes to this company, but me personally, in my personal opinion, where I'm going to put my hard-earned money, it's not going to be in a company like this that has negative cash from operations when it comes to their free cash flow. That to me is just way too uncertain. I don't like it, even if these target share prices are telling me that it's a screaming buy. And you could probably make really good amount of cash if you believe my assumptions. Obviously, if you believe my assumptions, because again, not financial advice, and every investment is the present value of all future cash flow. Please have these calculators, guys. They're available for free because, well, I don't like this company. Like, I'll admit it. I don't like their fundamentals. But you guys might have a different opinion, and that's perfectly fine. If you still like this company, please have these calculators. I have this one. I have the book value one. I have the reevaluation one, and a dividend tracking sheet for everybody to have. Because, you know, the way that I see it is like, I'm not here to tell you guys what to buy. I'm here to show you guys the process and my opinion on the companies that you guys tell me to analyze. I may like some of them, I may not like some of them, right? This is landing in the latter category for that. But with that said, that doesn't mean that you guys need to follow exactly what I'm doing. I do not want you guys to follow me exactly to a T, because I don't know your financial situation. I don't know who you guys are. I don't know what your risk tolerance is. So please have this calculator, make your own assumptions, and see whether or not you want to buy into this company. Me personally, I'm not. But all I'm asking for in return for free calculators and free daily content is just help me grow my channel. Like, subscribe, comment. Thank you so much for the 1,700 plus subscribers. I really do appreciate it. And we reached that goal by the end, well, actually sooner than 2023. So really do appreciate it, guys. For next year, I plan on making like a goal board. I don't know if that's the correct way to say it. Like a goal list, I guess you could say, for the channel. So let's see how that turns out. Again, the best way you guys can help me is just like, subscribe, comment. It really does help. All in all, when it comes to Sportsman Warehouse, I just don't really see the value when it comes to the fundamentals. Sure, the price is telling me that's a good price now, but it's just too much risk for me. Again, if you guys like it, Tony, if you like it, or if Michael, you like it, sure, by all means, you do your own due diligence. Of course, I will have the link in the description to the earnings report if you guys want to read it. But for me, it's a pass. That pretty much does it for this video. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. You guys can follow me on my YouTube sites. Link in the description below. So with that said, peace out. And I will see you all in the next stock analysis video, as well as earnings report.